Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. The impact of geopolitical risk depends on broader trends. Investors may wonder how they might impact financial markets and the economy. History shows that while geopolitical events can lead to market uncertainty and volatility, their impact on portfolios tends to be short-lived. Markets typically calm as situations evolve and eventually stabilize, leaving broader business cycle trends as the main drivers of performance. Thus, investors should resist making decisions based on headlines and instead focus on their long-term financial goals. This is why, from the perspective of investors, it's always important to separate feelings and beliefs around politics and global matters from portfolio decisions. History shows that the impact of regional conflicts on markets often depends more on the overall economic climate than on the conflicts themselves. This is clearly seen in the accompanying chart, which highlights many of the most impactful geopolitical events over the past few decades. In many cases, markets recovered within a few days or weeks, when they were affected at all. When markets did struggle for some time, this was largely due to broader market conditions, including the dot-com bust during which 9/11 occurred, or the rapid Fed rate hikes in 2022 that coincided with Russia's invasion of Ukraine. Conversely, most of the conflicts since the 2010s, including wars in the Middle East, the annexation of Crimea by Russia, and the ongoing nuclear threats in North Korea and Iran, were against the backdrop of an expansionary economic cycle. This helped to propel markets forward despite increased uncertainty. Oil prices can affect the global economy. When short-term disruptions to global markets occur, they tend to be the result of rising oil prices or supply chain disruptions. Issues with oil supply can lead to higher energy prices, potentially impacting inflation and economic growth globally. In 2022, oil prices rose to nearly $128 per barrel, propelling the average gasoline price in the U.S. to over $5 per gallon before falling once more. An important difference between today's environment and that of the past is that the U.S. is now the largest producer of both oil and gas in the world. Domestic oil production now exceeds 13.3 million barrels per day, more than Saudi Arabia, Russia, and other members of OPEC+. In theory, greater energy independence is one reason the U.S. may be more insulated from global events than in the past, although it still depends on imported oil for a variety of reasons. Markets are resilient, but investors should always prepare for uncertainty. While investors may feel as if there has been significant market uncertainty this year, the truth is that the stock market has experienced only 5% or worse pullbacks so far. These occurred in April and August due to worries over the Fed and economic growth. This is well below the historical average and is in the context of the S&P 500 generating a 20.8% year-to-date total return. This highlights the importance of staying invested and not overreacting to headlines, while also being prepared for periods of market volatility. So, although regional conflicts can increase the risk premium on financial assets due to increased uncertainty, it's often a mistake to make dramatic shifts in portfolios in response to geopolitical crises. The bottom line? While the situation in the Middle East is serious and deserves attention, investors should maintain perspective when it comes to their portfolios. It's important to work with a trusted advisor to construct a portfolio built around long-term financial plans that can handle periods of uncertainty. Thank you for listening. For additional information, please visit mraadvisory.com.